Okay, so again, good morning. So we are now on lesson 2 of working capital management as we discuss cash management. So cash management techniques such as cash budgets and cash mathematical models assist companies to manage its cash properly. So this lecture starts by introducing the objectives of cash management, followed by a discussion on what a cash budget is and how the cash mathematical models, particularly the Baumol model and Miller-Orr model, can be applied in managing cash. So this lecture discusses also how um, companies can utilize its excess cash by investing in marketable securities, and that will be on lesson 3. So for lesson 2, this is all about cash management. Okay, so cash plays a crucial role in a company's operation. So it is used to pay wages and salaries, trade payables, taxes, and dividends. So cash not only enables the company to promptly pay its creditors and suppliers, in promoting good business relationships, but also cash management lets the company take advantage of favorable business opportunities. So most importantly, it keeps the company liquid and prevents the company from insolvency or bankruptcy. So therefore, the objective of cash management is to maintain cash level, which will enable the company to meet its cash requirements and at the same time optimize the income on idle funds. So there are the following reasons for holding cash. So we have first, transaction motive. So transaction motive, cash is needed to facilitate the normal transactions and business operations. So as we know, cash is needed to pay bills, especially when cash disbursements are greater than cash receipts from business. So therefore, this transaction motive, this is the most important reason for keeping cash because this refers to the operating cash. Without that, the operations will be at risk of not continuing. Okay, so for the second reason, we have the precautionary motive. So cash is held beyond its normal operating requirement level in order to provide for a buffer against contingencies and unexpected losses. So, for example, if there is an unexpected delay in the collection of accounts receivable or a sudden increase in cost of materials, so there is a buffer or a cushion cash, no? So we call that, for example, in our personal lives, we call that the emergency fund, no? We keep cash for emergency purposes. Okay, so if reason number one, transaction motive, if we apply that in our personal finance, that refers to our cash that we set aside for our consumption, no, for our monthly consumption. While number two motive is the cash that we set aside for emergency purposes. That cash that is just there, that we will not touch for anything else, not unless there is an emergency. Okay, so that is like the same with businesses. So third is speculative motive. So cash is held ready for profit-making or investment opportunities. So there may be unexpected profitable opportunities when doing businesses, like speculative interest rate movements, like the BSP will announce that there will be an increase in the interest rate for the next coming 6 months. So that's a very good opportunity to invest in short-term money markets. Okay, so of course you need cash to invest on those opportunities. So like in our personal finance, for example, we refer to that money that we just set aside somewhere else, somewhere safe that we can use if there are profitable opportunities that will be presented to us, like a very good business deal, okay, or lowered stock prices. Of course, you need money to invest, okay, and that's just the same with businesses. And number 4, we have contractual motive. So cash is held as required by a financial institution or a contracting party. So therefore, we have cash, but we cannot use it because it is held as a compensating balance, or it is held as cash in escrow, no? So to accommodate our loans and other covenants. So we have that cash, but it 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 is untouchable, because if we touch that, we will breach the contract, and therefore our obligations will be demanded immediately. Okay, so these are the reasons for holding cash. Okay, so in this lecture, we will be discussing the following cash flow management techniques. Like accelerating collections, slowing disbursements, reducing the need for precautionary balance, and cash flow synchronization. And also, we'll be discussing some proven ways to manage effectively cash flows, like cash budget preparation, cash break-even chart, optimal cash balance, and cash conversion cycle. Okay, so in accelerating collections, how can we do this? So we can do this by prompt billings. So we will bill the customers as soon as we can. Second, we offer trade and cash discounts. So by offering trade and cash discounts, we will motivate the customers to pay as soon as possible to take advantage of the cash discounts. So we have third, maintenance of regional collections office. So this is true because back in the traditional days, the customers will be paying straight directly to the headquarters office, and that would take time for clearing of checks and delays in the mailing. So that's why one of the proven ways to accelerate collection is by maintaining regional collections office. Okay, so fourth, we have regular follow-up. So, of course, nothing beats regularly following up with customers as to their unpaid balances. Okay, next, we have legal action for delinquent actions. Okay, so, of course, we will do this if the receivable amount is sufficient enough, cost-wise or cost-benefit-wise, that we will pursue legal action only if the benefits out of that efforts will be greater than the legal costs. Okay, so we also have lockbox plan. Okay, so lockbox system. Okay, so back in the days na nga, and when people or customers are paying directly to the corporate headquarters, lockbox system is there's post mail, no? There's postal boxes in every locality. So that's why it is called a lockbox. So it's automatically sent to post offices, to post boxes. That's why it's lockbox plan. Okay, so we also have concentration banking. So channeled to one or few larger banks from the local depository banks. Okay, so like here in the Philippines, so some merchants are really particular, like channeled through BDO, channeled through BPI, or channeled through Metro Bank. So that's just an example. We also have pre-authorized debits. So this is like this works like, you know, linking bank accounts. So automatically when the customers' accounts will be due on specific dates, it will be automatically debited to their bank accounts. Okay, so that's why there's pre-authorized debits. Okay, so it's just like pre-authorized automatic payments. If you have experienced it through PayPal, it is automatically linked to your account, and it's automatically debited on a specific period, especially if you have subscriptions or anything like that. And of course, we have now the electronic transfers, no? So people can now easily pay because it is just by the click of the hands, no? Right? And in today's time that we can actually pay from anywhere, no, and from any time. Okay, so it's everything now is through electronic payments like GCash or Paywaner or Paymaya or bank accounts. Okay, so these are some of the ways we can accelerate collections. So we will accelerate collections because this is already the cash of the company, but it is tied in the customer's hands. This cash actually do not earn interest anymore. So the faster you collect the cash, the better it is for the operations. Okay, so this is self-check number 1. Okay, so we have here if we can speed up the collections, the opposite of that will be also helpful, like when we slow down our disbursements. So if we slow down our disbursements or we delay our disbursements, that means more cash is being retained by the operations and more cash is available as working capital. So that's why we need to slow down disbursements as one of the effective or cash flow management technique. So we can do this by first delaying payment. So paying on the last day of the credit period if there's no trade or cash discount being offered. So actually, if you are having, if you have experience using credit cards, so this actually is very true because you can actually specify which date your credit card or your payable will be due. So you can actually schedule, no? Smartly schedule your purchases and all other transactions that will be charged to your credit card in a way that it will be it it's a smart use of time, and because it gives you more time. So for example, um, just um, just think of it like if you smartly schedule your purchases, for example, your credit card will be due every 25th. Okay, so if you want to really make use of that, you'll start purchasing mga 27th because that will add another month to your deadline, no? So, well, that's an example of smart use of cash flow by delaying payment up to the last day as long as it does not have charge interest yet. Okay, second is play the float. So there's two kinds of float, the disbursement float and collections float. So what is meant by float? Float is the time it takes for the company's check to clear the banking system. So for instance, you issue already a check, it doesn't actually automatically deduct the amount from your um, account. So for example, you issue now your check and then there's a float of let's say 5 days or 3 days. So actually you can pay now, but in essence your cash, the cash of your business will be deducted only after 5 days or only after 3 days. So you have to take advantage of that float. Okay, So next we have centralized processing of payables. So it will definitely slow down disbursements because it is a one-time payment. So centralized by bulk paying, okay, bulk processing of payables. And next we have zero balance accounts. So these are special disbursement accounts that have a zero balance on which checks are written. So they are actually parang self-liquidating accounts. So there are, when you issue a check, after that, the balance of that account will be automatically zero. Okay, so another way is by reducing the need for precautionary balance. So again, as can be recalled, one reason for holding cash is because of the precautionary reason. Precautionary means that you are using this as a buffer or as a cushion or for emergency purposes. So one way that we can reduce the need for this precautionary balance is by matching the timing of cash outflows with your cash inflows. So for a business, for example, if you want to reduce your precautionary balance, you have to match the payment to your suppliers matching with your credit terms offered to your customers. So it should be properly matched so that in a way that you can receive or you can collect already the cash from customers before you will pay your supplier. So that is the best timing, no? Do not do it the other way, like you will wait for the suppliers to come knocking at your door and then the customers have not yet paid you yet, so you really have to have a precautionary balance. So the best timing is that you set your credit terms in relation to the credit terms offered by your supplier. So if your supplier is offering you N45, 45 days, then it is better that your receivable management will set credit term for the company for 30 days. So that being said, on the 30th day, the company will be collecting the receivables now from the customers. Then the cash is already there, and then by the 45th day that the supplier will come to you and collect, so you can actually pay. So you need to match the timing. So it's just like for personal finance, if you fail to time or if you fail to match your cash outflows with your cash inflows and you have no emergency fund, then of course, depending on or settling with your obligations with more debt, that's very inevitable, no? So for personal finance, if you put it that way, if you have the inflows, if you will receive your inflows or salary or your allowance by the 30th day, make sure that all your cash obligations will be settled by then, not before that time. Because if you have no salary yet by 30th and then you have these purchases, you have this credit card dues by 15th or 20th, so of course you have no cash, you have no inflow yet to pay. So what will happen is you will resort to your emergency fund, or the worst, you will settle with utang, or you will settle with having credits. Okay, so that's one management technique for cash flow that you need to properly match. Okay, so that you can reduce the need for precautionary balance, and that cash from the precautionary balance will be used instead in a more productive and more higher earning investments. Okay, so another way is to synchronize cash flow. The one way to synchronize cash flow is through lines of credit. So lines of credit are pre-arranged loan where the company can withdraw anytime within the period agreed upon. So, lines of credit, for example, you will apply to BDO for a line of credit specifying the period, let's say for 3 months, 3 months line of credit. So, that means that you can withdraw from BDO anytime as long as it is within the loan amount, allowed loanable amount, and within the 3 months. So that's one way to synchronize cash flow, because you can actually, you don't have to have cash at hand, but there's already a guaranteed source of that cash should obligations arise. Okay, so you can easily go to BDO and withdraw anytime within the 3 months as long as it is within allowable loan amount, let's say 1 million for that line of credit. So second is temporary investment. So another way is to invest in highly liquid securities. So instead of holding cash, for instance, you will hold emergency fund for the company, good for 3 months working capital. Okay, so instead of doing that, you can hold actually good for 1 month only and invest the rest of the cash to highly liquid securities like 60-day commercial deposit or 60-day time deposit or 60-day treasury bill that can be easily converted to cash should need arise. Okay, so those are the ways. Okay, so please try out soft check number 2. Okay, so how do companies really manage cash flows? So the first is by preparing cash budget. So what is a cash budget? A cash budget is a listing of all potential cash collections as well as future payments. So it is prepared in a schedule to determine cash balances and requirements for a particular period. So, of course, firms need to forecast their cash flows because if they are likely to need additional cash, they should line up funds well in advance. So, on the other hand, if they are likely to generate surplus cash, they have excess cash, then they should plan for its productive use. So that's why it is very important to prepare cash budget. So not just for corporations or for businesses, but more importantly for individual level. No, you prepare your cash budget. So for a company, the monthly cash budget begins with a sales forecast for each month. So if you can recall your short-term budgeting, so your budget starts with a sales forecast, right? Then you project the actual collections. Okay, so then if there is from that forecasted sales, you have the forecasted collections, then you need to forecast also the production cost, like the cost of the materials purchases, the payments for the materials, payment for the labor, payment for leases, new equipment, taxes, and other expenses. So when all these forecasted payments are subtracted from your forecasted collections, the result is either expected net cash gain or loss for each month. So this cash deficit or surplus will be added or subtracted from your beginning cash balance, and the result is the amount of cash that the firm would have on hand at the end of the month. So if it is not borrowed nor invested, so if on hand lang. So that's why we need to do cash budget, so that if we can see that on a particular month there's a cash deposit, we need to plan in advance how to replenish or how to make do of the deficit. No, so we can advance where we can get the funds on that particular month. So similarly, if on a particular month there is a surplus, then we could plan where to put that excess cash. of course, no, we need to, it's a constant decision to where to put extra cash, because keeping too much cash, it's not good, because the cash will become idle because it will not be earning. Okay, and keeping too low of cash is also not good, no, you will risk liquidity. Okay, so that's the rationale for the cash budget preparation. Okay, so check this out, self-check number 3. Okay, so next we have the cash break-even chart. So this is just like the traditional break-even chart. So this cash break-even chart shows the relationship between the company's cash needs and cash sources. So this indicates the minimum amount of cash that should be maintained to enable the company to meet its obligations. So as you can see here, let's just use a highlighter. So you can see here, this is the total cash generated, this line here. And we have here the cash variable cost. Okay, so this point here is the cash break-even point. Okay, so this is the minimum cash that should be maintained to enable to meet its obligations. So it already covers the fixed cash needs and the variable cash needs. Okay, so just like break-even point, the formula would be fixed cost, the cash basis only, divided by contribution margin per unit. Okay, so going back, we have the optimal cash balance. So optimal cash balance means getting enough cash to meet maturing obligations that is not too large, not to incur opportunity cost of holding on to excess cash, um, but just enough, okay, so that the cash can be put into more productive alternatives. So we have the Baumol model here. So Baumol model balances the opportunity cost of holding cash. So the opportunity cost of holding cash and balances it against the transaction cost associated with replenishing the cash account. So we have the holding cost plus transaction cost makes up the total cost. Okay, so holding cost can be derived by the average cash balance multiplied by opportunity cost. How do we get the average cash balance? So average cash balance is the amount of cash raised for each transaction divided by 2. Okay, so we have the transaction cost. How do we get the total transaction cost? The number of transactions, just multiply it by the cost per transaction. So the number of transactions, like this is the total amount that the new cash is being withdrawn, no? So one withdrawal, let's say you will get cash, that's one transaction, then the next month you will get another cash, it's the second transaction. So transaction cost is just the number of transactions multiplied by the cost per transaction. Okay, so we have here the Baumol model is actually just like an adaptation of the ECQ in inventory. It's the economic conversion quantity. So this is the optimal cash transfer. Okay, so at ECQ, okay, so ECQ, that's for the cash. If the inventory model is the EOQ, economic order quantity. Here it is ECQ, the economic conversion quantity, or the optimal cash transfer. The optimal cash balance will be withdrawn every time. So, of course, we know that at ECQ, the holding cost will be equal to transaction cost. Okay, so it is the formula 2 times A times F divided by the opportunity cost. So we have the cost of each withdrawal multiplied by the used the optimal or the use of cash per period. Okay, just multiply that by 2 and then multiply that by the withdrawal cost. Divide by the the opportunity cost. So it's like todo K. In EOQ, we are familiar with todo K. So here, it is still the same. 2AF, no? So 2 multiplied by the annual or the monthly cash disbursement times the fixed cost per transaction. So divided by the opportunity cost of holding cash. So the opportunity cost of holding cash is the percent of return that cash should be earning if it is invested in a marketable securities. So for instance, if that cash will be invested in a marketable securities that will be earning 5%, then that 5% is its opportunity cost. Okay, so we have here cash conversion cycle. So cash conversion cycle can be derived by adding the inventory conversion period plus the receivable collection period, then subtract the payable deferral period. So again, cash conversion cycle is equal to inventory conversion period plus receivable collection period minus payable deferral period. So what is the best cash conversion cycle? Is it positive or negative? Okay, so the answer is negative because let's just explain, because if the result for this equation is negative, then that means that you are collecting cash way earlier than you are about to pay your payable. So, for example, inventory conversion period natin is 30 plus receivable collection period natin is 20 minus our payable deferral period of 60. So that will give us a negative 10 cash conversion cycle. And generally, that is very good because we already have money collected by 50th day before we can pay the payables to our suppliers by the 60th day. So that's a very simple way to understand this. If the cash conversion cycle is negative, then that is good. It becomes a problem if the cash conversion cycle will be positive and longer. Okay, so our bottom line is to shorten the cash conversion cycle as possible as we can. So we have the inventory conversion period. So this is inventory divided by sales per day. So this is actually the inventory turnover period. So we also have the receivable collection. So in period. Okay, so receivables divided by the accounts receivable turnover. And that is the time to collect our receivables plus the time to convert our inventory less the time to pay our payables, our suppliers payable. Okay, so check out your understanding. Answer self-check number 4. Okay, so that is all for this video lecture. And next lesson coming up will be the actual solving of those topics that I have discussed in this lecture.